Hey guys, welcome back to the classroom. So today we are going to go over technical analysis basics. This is lesson 3, but before we do, we have some announcements. So this is the final week of basics training. Go back to all the lessons up until this point. If you have any questions, this is the time to reach out and ask questions. And make sure you follow up with the lessons this week that are following this lesson and have them all done before Sunday. Don't wait till Sunday last minute unless you're going to spend all day Sunday studying, which is going to be a lot of content to take in at one time. I prefer you guys break it up. That's what makes it easy peasy, right? Taking it in small bites. Okay, you can eat an elephant one bite at a time, right? Ooh, who eats elephants? I don't even know why they say that. Anyway, set up your charts. So that's one of the lessons that I need you guys to make sure you have done before Sunday, because if you have any problems, any technical issues, you need to ask me by Friday. I promise you need to ask me by Friday so I can help you guys get set up. I don't do anything on Saturdays. Saturdays is my day of rest. So I don't do anything on Saturdays. So you need to ask me by Friday, okay? And don't all ask me at the same time. Do not wait till the last minute, guys. That is the only thing that I want to stress, okay, because you will not get the most out of this whole membership. You definitely won't get the most out of me waiting to the last minute, okay? I need time, ample time to help you guys work through whatever issues you're having. So go ahead and maybe start that tonight, setting up your charts, start that video lesson tonight, and that way you have the rest of the week to get it done and ask me questions. Also, this new indicator has been released to you guys. Depending on your membership level, you have different features, access to different strategies that go with it. So definitely check out the new indicator that has been released in the Easy Peasy Classroom. You'll find it as in one of the posts. And also the Google Classroom has been open to you guys. Again, depending on your membership level, you'll have access to a Google Classroom that has everything a lot more organized for you guys, okay? If you have not consider upgrading to Explorer Plan so you know what the heck I'm talking about, because you will not see everything that I'm mentioning if you're not at least at the Explorer Plan. So if you're confused, if you're lost, if you don't know what's going on, if you can't find things, most likely it's because you haven't upgraded to the Explorer Plan. It's $1.99. Think of it as a free trial. You are learning how to trade. You're going to know how to go. I'm going to show you guys a challenge. Everybody that has Explorer Plan up $100 to $1 million, right, in 4 months, right? But think about it. You can't pay more than $1.99 to learn how to turn $100 into $1 million. Then you don't have the right mindset for trading. And it's probably just need to stay a free member. But if you guys are really interested in learning how to compound money through trading, then invest, right? So at least consider upgrading to the Explorer Plan so that you can unlock some of these features. You don't get much, but at least you are on your way to making a lot more money in a short period of time. All right, let's go through the disclaimer. You guys know that I'm not a financial advisor, and everything I'm providing, me, myself, my affiliates, directors, employees, officers, we're all providing these things for educational purposes. If you have questions about risk and it seems unclear to you, make sure you seek independent financial advice. Get out your notebooks and take notes. As always, you should have a dedicated notebook for learning how to trade. For anything related to trading, you should have a dedicated notebook for that. Also, if there's a study guide associated, a pre-quiz, make sure you have your questionnaire on hand, especially when you go back through the lessons, because that's pretty much what it's designed for you guys when you're working independently. And write down any additional questions you have for the live Q&A session at the end of this lesson and any other sessions that we have. All right, let's go ahead and get started.
Technical Analysis Basics. In the Trading Basics series, we covered the 3 principles of technical analysis. We already know that technical analysis is primarily used to identify the next trend as early as possible. This gives the trader the opportunity to ride the trend and take advantage of the potential rally. Traders have a lot of tools to help them in the quest to find the trend. For example, employing popular price patterns such as the head and shoulders can assist in identifying trends at their earliest stages. Trend lines guide traders to navigate the financial markets like the compass guides the sailor to navigate the open seas. If the price honors the trend line, the prevailing trend remains intact. If the trend line is violated, this is seen as a warning that the prevailing trend may be coming to an end. Indicators and oscillators are also very popular tools for technical traders, and the MACD is among the most used. When the MACD crosses above the zero line, it signals an uptrend. When it falls below the zero line, it signals the beginning of a downward movement. Traders are advised to combine a variety of tools rather than taking the much riskier option of relying on a single one. There are many more tools that technical traders use, which we will cover in this series. There are three main chart types that traders use to read the markets, specifically to determine the movement of price and identify trends. The first chart we are covering as part of FXTM's Technical Analysis Basics video series is bar chart. This is a Western technique for price charting, comprised of a vertical line that represents the price range of a specific time period. The time period depends on your chart. The most popular periods are hourly, daily, weekly, and monthly. The highest point on the bar represents the high price of the financial asset in question, and the lowest point represents the low price. The distance between these 2 points is the price range. A tick to the left represents the opening price, and a tick to the right represents the closing price. The vertical line, together with the left and right ticks, is referred to as the bar. 2 consecutive bars represent specific relationships that technical traders recognize. These include up day, which usually means there are more buyers than sellers; down day, which implies more sellers than buyers; inside day, which implies a pause in market action; and outside day, which implies a lot of activity and volatility in the market. Next up is one of the most important and popular price charts, the Japanese candlestick. The Japanese version of price charting uses a shape similar to a candlestick as a visual representation. The Japanese candlestick method of viewing charts is one of, if not the, most popular methods of looking at charts. One candlestick shows the open, high, close, and low points of the price at a given time frame. The shadow or wick shows the distance between the high and the low. The body of the candle or real body measures the distance between the open and close. When the close is higher than the open price, then the body of the candlestick is white. This reflects a positive sentiment in the market. When the close is lower than the open price, then the body of the candlestick is black. This reflects a negative sentiment in the market. There are many different shapes and sizes to the candlesticks, and the patterns they form, all of them with their own special names. For example, one of the simplest and most popular candlestick patterns is called the hammer. This is when the candle has a long lower shadow and a short body, with tiny or no shadow on top. The hammer is made up of just one candle and is a type of bullish reversal candlestick. We will be covering trend reversals in an upcoming video. Stay tuned to FXTM Technical Analysis Basics to find out more. A lot of traders prefer the line chart to Japanese candlesticks or bars. For example, many traders who trade the stock market prefer to use the line chart to see price movements. This is because they consider the closing price to be the most important price of all. The line chart basically consists of the closing price for each period. Of all three charting methods, the line chart is the simplest and most easily understood by beginners. No specialized knowledge is required, and they give the big picture of the market. On the other hand, they lack a lot of information that bar charts and especially candlestick charts show. For example, the open, the high, and the low price. For this reason, they can be misleading, and traders should take caution if they decide to use this type of charting method. Stay tuned for more technical analysis basic videos. You may have already heard popular phrases like "the trend is your friend" and "follow the trend." But what is trend exactly? In its simplest definition, trend means the direction of the market. In more technical terms, trend is the direction of successive tops and bottoms. There are three main types of trends: uptrend, downtrend, and sideways. During an uptrend, there are higher tops and higher bottoms. On closer inspection, one can notice that each top is higher than the previous top, and also each bottom is higher than the previous bottom. An uptrend is likely to continue in the same direction. In a downtrend, there are lower tops and lower bottoms. On closer inspection, one can notice that each top is lower than the previous top, and each bottom is lower than the previous bottom. A downtrend is likely to continue in the same direction. When the market is not trending, it doesn't move upwards or downwards. Instead, it moves sideways. On closer inspection, one will notice that in sideways movement, there are approximately equal tops and equal bottoms. Another way of defining this sideways movement is range. Unlike uptrend and downtrend, a range is more likely to break out either above or below. So now you know why the trend is your friend. Until next time, traders. Now that we are familiar with trend, it's time to get into more detail about the three main types of trend directions. Let's look at uptrend first. Uptrend is a series of successfully higher tops and higher bottoms. If the pattern holds, the uptrend remains intact. The line that connects two or more bottoms is called the uptrend line. A minimum of 2 bottoms are needed to make an uptrend line. But the more bottoms used, the more traders feel confident in the uptrend. The uptrend line acts as support, while the tops act as resistance. The usual trajectory of price is that once it reaches the uptrend line, it bounces back up to move even higher. When supply becomes greater than demand, take note that the uptrend line may be breached. Next up in our video series is the downtrend. Stay tuned. We've covered uptrend, so it's only natural that we discuss its polar opposite, the downtrend. Downtrend is a series of successfully lower tops and lower bottoms, which create a downward pattern on the price chart. Though they are completely opposite, the downtrend is like the uptrend. If its pattern holds, it remains intact. The line that connects 2 or more tops is called the downtrend line. A minimum of 2 tops are needed to make a downtrend line. But the more tops used to draw that line, the more traders feel confident in the downtrend because it reinforces the direction. The downtrend line acts as the resistance, while the bottoms act as support. In this context, the usual trajectory of price is that once it reaches the downtrend line, it rebounds to register even lower. When demand becomes greater than supply, the downtrend line will be breached. Next up is the final type of trend, which isn't even a trend line. We're talking range. See you then. We've gone through both uptrend and downtrend, so now let's look at an example of when the market isn't going up or down. When the market appears to be trending sideways, we call this a range. In fact, since there appears to be no apparent trend, another term used to describe this type of market is trendless. In a range, the action of the price is confined within the boundaries of support and resistance lines. On closer inspection, one notices that the highs of the tops are approximately equal to each other, as are the lows of the bottoms. A range is more likely to break out either above the resistance or below the support. Where trend-following traders put a lot of weight on uptrends and downtrends, range traders focus on ranges. Range traders identify support as oversold levels of their instrument and resistance as the overbought area. Their tendency is to buy at the oversold or support level and sell at the overbought or resistance level. That's range in a nutshell. See you soon for the next video, traders. Support and resistance are 2 of the most popular terms in trading the financial markets. Support on a price chart is a price level which signifies more buyers than sellers. In other words, more demand than supply. Take a look at this example. Support is always below the current price. On the flip side, resistance on a price chart is a price level which signifies more sellers than buyers. In other words, more supply than demand. Resistance is always above the current price. When the market is trending, however, things are not as simple. For example, during a downtrend, bottoms form support, but supply is actually greater than demand. As a result, support is usually breached. During an uptrend, tops form resistance, but demand is greater than supply. As a result, resistance is usually breached. When a resistance is breached, it becomes support, and vice versa. It's important to remember that support and resistance are relative to the current price. Anything above the current price is resistance, and anything below the current price is support. A lot of beginner traders are faced with this classic dilemma. When is the right time to buy or sell? Do they follow the trend? Should they trade the range, which appears more predictable? If you have asked these questions as well, here are some tips that may help you find the answers you're looking for. Forget the idea of beating the market. Let the market follow its course and trade it accordingly. Check your ego before you trade. Professional traders do not let their egos determine their judgments. Be humble when trading Forex and other markets. It's always better to make money than to be right. A prevailing trend is more likely to continue than to reverse. Use it as your compass in the markets. This means buy in an uptrend as prices are more likely to rally higher than reverse. And sell in a downtrend as prices are more likely to keep falling than reverse. Finally, always remember that there are no guarantees. Reversals do happen, and the market will follow its course no matter what. So you must practice good risk management at all times. A trend reversal marks the end of an existing trend and the beginning of a new one. A reversal may happen in any time frame and can mean the difference between a big win, a break-even, or a loss. Being able to effectively spot a reversal is the fastest way to jump on a new trade. As we have seen in previous videos, a trend is the direction of successive tops and successive bottoms. Let's look at an example of a popular reversal. The head and shoulders reversal is formed at the end of an uptrend. The highest top is the head. The top to the left of the head is the left shoulder, and on the right is the right shoulder. The line that connects the last two bottoms is known as the neckline, which acts as support. A break below the neckline forms the reversal pattern of head and shoulders that marks the end of the uptrend and the beginning of a downtrend. We've got one more technical analysis basics video in store for you. See you then! Discipline is an integral part of any trading strategy. Without discipline, a solid trading system and proper risk management lose their value. The good news is that discipline can be mastered. All that's required is some willpower on your part. This involves carefully studying the markets, especially the ones you are trading, and mastering your self-control. In order to master discipline, you must practice patience and be able to control common emotional impulses like greed and fear. In more technical terms, proper discipline involves having and sticking to a trading plan. Create a schedule for your trading. Know what signals will make you enter or exit a trade. Ensure that you apply proper risk management by sticking to your stop loss and take profit orders. If you stick to the rules without trying to outsmart the market, you will find out that discipline is a prerequisite for success. Technical Analysis Basics.
Okay, guys.
In the Trading Basics series, we covered the three principles of technical analysis.
But very important.
We already know that technical analysis is primarily used to identify the next trend as early as possible.
Buying and selling with your conditions forward.
This gives the trader the opportunity to ride the trend and take advantage of the potential rally.
Is discipline, because once
traders have a lot of tools to help them in the quest to find the trend. For example, employing popular price patterns such as the head and shoulders can assist in identifying trends at their earliest stages.
Sometimes it could be used.
Trend lines guide traders to navigate the financial markets, like the compass guides the sailor to navigate the open seas. If the price honors the trend line, the prevailing trend remains intact. If the trend line is violated, this is seen as a warning that the prevailing trend may be coming to an end. Indicators and oscillators are also very popular tools for technical traders. traders,
It's quiz
and the
time. So we're going to
MACD
go
is
through the
among the
quiz.
most used.
It's not that long, so we'll be short. The class will be, you have guys will have more time to ask your questions at the end of this class because we're just at the 20-minute mark. So the first question is, or the first fill in the blank is, in its simplest definition, blank means the direction of the market. What do we say is your friend? What do we say is your friend? It's the trend, right? The trend, it means the direction of the market. So when we're saying the market is trending, we're saying it's going in a particular way. It could either go what? There's three ways. Uptrend, you guys have heard me say that a million times if you've been in my private classes. Uptrend, downtrend, or sideways, right? Ranging is what we call it. Excuse me. Some people call it consolidation. So accumulation, right? So uptrend, downtrend, or sideways, right? The trend is the direction. During an uptrend, there are blank tops and blank bottoms. There are what kind of, they said in the video, during an uptrend, there are blank tops and blank bottoms. Higher, right? An uptrend is, we call it higher highs, right? And higher lows, where tops are highs and bottoms are lows. So if it's uptrend, it's going like this, up, down, then it goes higher, and then this low right here is still going to be higher. You guys are going to see me do that in a demonstration video after this lesson. So just make sure you follow up with these lessons because I'm going to demonstrate a lot of these concepts, okay? In a downtrend, there are blank tops and blank bottoms. So if an uptrend are higher tops and higher bottoms, in a downtrend, you recognize it by lower tops and lower bottoms, okay? So that's what a downtrend looks like, okay? Lower tops and lower bottoms, right? When the market is not trending, okay, it's not trending. It doesn't move upwards or downwards. Instead, it moves what? It doesn't move up, it doesn't move down, it moves sideways. Right? The sideways market, also called a ranging market, also you've heard of it, consolidation. Okay, sideways markets have something you're going to support and resistance a lot of times are identified by sideways markets. You did see it you can see it also in trend lines, uptrend and downtrend. Those are also diagonal support and resistance, but the sideways markets, you're going to hear people say support or demand zones or supply. Supply and demand zones or support and resistance. But a lot of times they identify it with sideways movement. And an uptrend and downtrend, unlike an uptrend and downtrend, a range is more likely to blank either above or below. Think of a consolidation zone. What do we expect to happen in the consolidation zone? We expect a breakout to happen, right? So we are more likely to break or break out either above or below, right? So that's it for this lesson. I'm going to stop the video and give you guys a chance to ask questions. But know that the next lesson or the next week's lesson, lesson 4, is smart money concepts. Okay, that's a smart money concept. We're going to go right into studying about how the market actually moves, trading like the banks. We're going to go straight into that next week. Okay, so this week you need to finish this, go back and watch this lesson. You need to follow with all the lessons in between, 3A, 3B, whatever's in between, to be ready for next week. All right, guys, thank you guys for your time, and I'll see you guys literally in the classroom. You guys that are watching this live, just stay here. We're going to go ahead and get your questions answered. All right, talk soon. Bye now.